Justin Edwards, Head of Fuel Oil Procurement at Euronav, Ahmed Mahdi, Visiting Fellow at the Oxford Institute for Energy Studies and Director of Renaissance Energy, and Yasar Al-Malki, Gulf Analyst at MEES, Middle East Economic Survey. Thanks so much, everyone, for joining us. Great to have you all. We had that survey response that we had put to our viewers yesterday, which showed that the majority actually felt that the sort of financial bubbles that we're seeing in the US and to an extent it reverberates in Europe are weighing more on oil market sentiment than Asian demand. Ahmed, let me go to you. We haven't heard you for a while on the program. Would you agree with that result? What do you think is sort of influencing oil market stakeholders at the moment, or operators?
Hi, Diallo. Nice to be on your show again. Yeah, so I think that obviously the market is a little bit in a risk-off mood at the moment. The paper market has sort of there's a tussle between effectively the ongoing efforts by the Fed to tame inflation, and then also you have the financial market effectively ongoing issues with the banking sector. I think actually, despite the fact that it's, the markets, the sentiment remains negative, it's not, there's very little in the way of sort of new data on the fundamental side to justify that sell-off. But obviously investors are getting a bit nervous about the macro outlook and the implications for oil demand. In saying that, certainly from, since the announcement by OPEC around the cuts, and even before then, actually, there has been a lot of volatility going on on the product side in terms of refining margins. So there are changes going on, and also obviously you have maintenance going on in Asia as well. But I think we can discuss a bit later, but there are other factors at play. But I think at the moment, this is, a lot of this is around the sort of in terms of a technical sell-off, rather than any sort of major shift in the sort of outlook for fundamentals. Just very briefly, I would say one other thing is that there's also one of the aspects of the market as well is that, where the majority of demand growth will come from this year, 50% of that will be from China. So there's also, people are keeping their eyes on that. So your question on the survey is, it's it's a little bit of both, really. I mean, there's a difference between in terms of how the market operates. Yeah.
Yeah, I mean, and both of those are factors obviously weighing on sentiment. It's just about where the mood is weighing more on at the moment. Rustin, let me go to you on that. I mean, you've always been quite a bear in terms of the fundamental outlook for demand this year, while everyone else was sort of following the technicals of the oil price. Ahmed just mentioned this sort of drop. We're seeing inventories drop, and yet we're seeing drops in oil prices as well, which are counterintuitive. But where would you stand today? And we're midway through the second quarter. Outlook for prices, for product demand, jet fuel, etc. Well, we should be in full swing by now, no?
Well, we're not, because the world economy is not as strong as everybody wants to say. I mean, you look at the recent data that's come out of China, the big consumer. You've had industrial profits off 21.9%. Last month, you had Chinese manufacturing PMI go back into contraction, 49.7, and other Asian economies going into contraction. The only bright spot in Asia currently is India, which actually showed PMI manufacturing growth. Manufacturing is the big driver of oil demand in most economies. And so if you've got contraction in China, how can you have robust demand? Now, China is importing a lot of crude, but they're exporting a lot of product, and that's driving their GDP numbers that they see coming out, because the crude they're getting is very discounted. Product margins are still pretty tight, pretty good. So of course, they're going to run as hard as they can, capture that margin, and export the products in the market. When you look at products overall, distillate stocks globally are above the 5-year average. Distillate is the main industrial fuel. If distillate stocks are building on the global basis, and you've got contango in every pricing market now in distillate, it doesn't tell you that demand is as strong as everybody wants to make it out to be. And when you look at the overall numbers, you have jet fuel demand in the United States still down 9% from pre-COVID levels. Gasoline demand still off 4% pre-COVID levels. And we're going into the Memorial Day weekend, and gasoline is not performing as everybody expects it to perform. I mean, based on historic Memorial Day inputs for demand, we need about 1 million barrels of incremental demand to pop up in order to have a good gasoline season in the United States. So that's about how far we're lagging right now on gasoline demand overall in the US. So I think what we'll see is that we'll see continued pressure on refining margins as stocks continue to build and demand doesn't materialize.
Okay, yeah, sir. On that point of product demand and those indicators, you know, on the manufacturing side for diesel, etc., and gasoline, driving season, as Rustin just said, is starting and kicking off in the US. I mean, compared to last year, we had that whole gasoline price rise, and of course the pressure politically from the US on that on OPEC. Yes, so what's Misa's sort of outlook for the next quarter, if you like, full quarter up to the end of Q3? Are we going to see the second half recovery that everyone's been talking about, despite what Rustin just said?
Well, thank you for having me. Well, it really depends on how the market is going to shape up to the second half. Right now, what we have is strong market sentiment that is grappling the market in a way, and there are concerns on slower than expected global economic growth, and this is adding downside risks to oil demand. The economic situation is highly fragile and uncertain. The troubles in the banking sector are part of a larger, would say, picture of challenges that are faced. You know, we are now waiting for the Federal Reserve and other central banks to come up with their decisions on hiking interest rates. There is high inflation, monetary tightening measures, high levels of sovereign, corporate, and private debt, and all of these are the factors that are driving the sentiment at the moment. As Ahmed said at the beginning, there is little change to the fundamentals, you know, in terms of supply and demand. Even OPEC and the IEA in their latest April reports, you know, they were practically on the same picture, to above 2 million barrels per day of forecasted end of 2023 demand growth. Maybe the EIA was a bit less bullish with 1.4 million barrels per day, but the situation will definitely depend on market sentiment, on how the market participants are thinking. Bearishness is quite strong at the moment. So when you look at it, OPEC has two headline cuts, one for 2 million barrels per day in November and another to start in May for OPEC Plus for 1.6 million barrels per day. And yet the oil price has not moved or stabilized at $80 per barrel. So this is more about not just OPEC managing the supply side, but also the sentiment side. And this might prove to be quite difficult, because this would require unity within the group itself and so many other factors.
Okay, well, I mean, talking about OPEC, Ahmed, back to you. And of course, just, I mean, you touched, Yasser, on the banking crisis. I mean, you know, the Fed today will be coming out with its next interest rate declaration, apart from other indicators going forward. I think the main question really for the energy markets is, how correlated are they anyway to this whole inflation story? I mean, the Fed will keep fighting inflation. I think most people are agreeing with that. But Ahmed, you know, how correlated are oil markets to that? Some of the analysts we have on say, you know, oil can keep going up even if we see equities drop, consumer sentiments drop in equities in the US. Supply-wise, Ahmed, let's go to that now and talk about Russia and talk about OPEC supply as well. We have a headline in our bulletin today talking about output falls because of Iraq pipeline holds, Nigeria strike, etc. The usual trouble areas again. Any panic about supply? Any qualms there about that we're not going to get enough supply, putting aside the OPEC cuts?
You covered a lot there, Diala. So from the Fed to supply.
Let's
yeah.
start
So
with
but let me just respond to the first point made by the first speaker. So Look, I mean, fundamentally, look, you know, every day there's that, you know, the market is very sensitive to you know, announcements by the Fed, and I think everyone's going to be looking for guidance as to where the peak terminal rate will be, and also at the same time in the backdrop, there's a lot of nervousness around, you know, still ongoing nervousness around the sort of, you know, basically this banking crisis, but it's very different to historical episodes, largely because there are other features as well in the global economy. You know, still a tight labor market. We're still effectively in a stage where we had years of you know, liquidity, you know, in, you know, money supply in the market, and then suddenly overnight that was tightened. So something had to break. I don't think anyone, I think no one knows necessarily where that may go, but I think at the moment the expectation is that it can be managed. But at the same time, the Fed has a very difficult task ahead of itself in terms of managing, you know, the sort of flow of information. I think that's what people are looking at. But nevertheless, I think a 25 basis point hike is being priced in. But at the same time, the ECB is also talking about you know, a rate hike as well. I think that the forward curve for interest rate expectations may change, you know, depending upon how sticky inflation is, and that's naturally guiding sort of investor expectations, and that will also guide sentiment. But as my point in the beginning was to say, I'm not bullish necessarily, but what I'm trying to say is that we're still a bit too early to get any fresh guidance, because we still have, yes, PMIs have fallen, but still, you know, refining margins, you know, there is still room for some volatility. We have to also accept that with deferred maintenance on Russian products, there's still a lot of Russian barrels flowing around, Russian distillate, basically clean products floating around, and that's also having a sort of natural impact as well. China, I think that there's still, I don't think anyone can sort of confidently say that they have the full view on Chinese demand this year. We still have to wait and see what happens with the jet, which is basically where that marginal demand barrel will come from this year, with the jet reopening, jet fuel demand this year, and also the fact that the key, I think something that will be very interesting to watch actually will be where the government will, you know, what the government's guidance on product export quotas will be in the next batch, because that will give you an indication of their view of their forward demand cover numbers, and also we have to also, you know, the fact that when Russia does go into maintenance, you know, there's a lot of variables out there that are still, you know, we still have to look at. Just very briefly on actually we can talk about it later. I think maybe we'll pass on, but you know, on the question about Iraq, I think that probably we're still going to have this shut in for a little bit longer. I probably expect it to last until after the Turkey elections, actually. Yeah,
and I suppose the Iraq, Nigeria, Libya story, you know, maybe the market has learned to discount that anyway. You know, i.e., if it unless we're pleasantly surprised with a lot more supply than we would have been expecting. Rustin, back to you. Let's see. Give us an update on how the shipping sort of market's doing, if you like, with all these unknowns. I mean, how can shippers plan in one way? I'm not talking about long-term investment, but is there uncertainty among tanker markets now? I mean, you know, which had a bit of a boost recently. Now with this sort of more bearish outlook from your point of view, what's that doing to tanker rate outlooks, etc.?
Well, freight rates across the board have gotten weaker over the last couple of weeks. Of course, tanker rates took a hit upon the news of the OPEC cut, because anytime you potentially cut supply, you know, the mode of transportation always takes a bit of a wallop. And, you know, they're down from their highs of 70,000 a day, down to the upper 30s, low 40s, which are still good for tankers, but they're not as good as they were at the first quarter of the year. Container rates are still horrible. They're actually closer now to where they were back in 2017, 2018, when there was an oversupply of container ships in the marketplace. But that kind of also translates into the forward demand for consumer goods, because not only are container rates feeling pain, but when you look at the earnings reports from the logistics providers inside the United States, especially J.B. Hunt, one of the largest trucking companies, they're saying that their truckloads are down 50% year on year. So that you just don't have that in consumer buying demanding the use of their trucks to move stuff from breakout warehouses into stores. And so that all translates back into how hard can the Chinese economy actually run without that end user demand for consumer goods across the board. You're also seeing this in the petchem markets, because petchems are also not performing at the moment, even though everybody anticipated to be a strong petchem demand on the back of Chinese, which is then impacting clean freight for tankers as well, because you don't have the long haul naphtha traveling from Europe or Russia into China for reprocessing. It's kind of causing a backlog on those ships as well. So net, it's been container rates, shipping rates are all fairly low at the moment. We're hoping to see a second half recovery, because if the stories on China are true, then yes, there'll be an increase in freight, but we're just not seeing it yet.
Yeah, in the bulk freight and also the tankers, perhaps if we do see demand pick up, as you said, for oil in general. Yeah, so just back to you. Let's talk a bit about U.S. production as on the supply side. We've touched on Russia, touched on OPEC. OPEC has made it pretty clear what it's doing for the time being, holding back probably till it sees more evidence that we're talking about here today. There's so many unknowns in terms of where demand is going. So first of all, do you think that OPEC will sort of wait at least till July before it takes any further action? And secondly, where's the US production outlook for the second half or for the whole of 23? There seems to be a sentiment that it's going to be picking up a bit more this year, whereas it didn't last year. Is that correct?
Well, just on the OPEC demand expectations or changing decision, I think OPEC Plus as a whole group, I think what Mr. Novak said is right now the policy going forward, which is there is no change to direction in terms of supply cuts. There will be no more need for those. In terms of US production, so I think if you look at what happened over the last 2 years in the shale patch, what you had is basically mergers and acquisitions and bigger players coming into the market and taking smaller ones, but also you have basically drillers running out of DUCs, which are drilled but uncompleted wells. At the same time, now you have this call from banks to get back their money. So there is also pressure to utilize higher prices to increase production. But I think overall, the problem with shale oil or LTO is the fact that you have so many broken supply chains within the shale patch, and that is going to be problematic for a full rebound. But other than that, non-OPEC supply is also expected to increase. I mean, the EIA was speaking about higher supply from non-OPEC countries. But this is dependent on so many variables. One of them is severe underinvestment throughout the past few years. Even when you look at some of the production from OPEC itself, this has been greatly impacted. So just to go back to one of the titles that you had, news titles that you had earlier, which is Nigeria and Iraq and so on. You look at OPEC and throughout the past, well, maybe 1 year or so or more, what you had is, and a few months actually, what you had is the OPEC big gulf for basically sticking to their quotas, producing at quotas, and you had other countries struggling even to hit those ceilings and quotas. And this is especially true in Africa and other places. And this is maybe perhaps is also reflective of other non-OPEC suppliers where investment has been severely cut, especially from 2014 with the oil price collapse and also the COVID-19 crisis and so on.
And of course, there's the cushion of the new supply on OPEC. There's Brazil, Guyana, etc., which people are saying, could come in if needed. At the moment, there's obviously no call for that. Ahmed, I'll just go to you in a minute, but let's just see that question. Given the conflicting economic and financial indicators, is the oil market still factoring in a mild recession for the US and Europe in 2023 sometime? Things are slowing down, admittedly, but are we going to see, by definition, this mild recession or recession kicking in this year? So, is the oil market still feeling that, given that there's so many factors that are pushing and pulling either way? So we'll get the response to that. Ahmed, in terms of Russian supply, I mean, Yasser just referred to that. This sort of 500,000 that they were going to cut, or supposedly are cutting. Many are saying that hasn't happened, and it's not going to happen this year. Why would Russia do that? Would that be your thinking as well?
So I think that certainly the maybe if you remember 3 or 4 months ago, there were a lot of views out there that there would be serious disruption caused by the February embargo on products, particularly around logistics and clean tanker capacity and what have you. I think actually, and I think partly, when we look at sort of particularly distillate cracks, and when we look at refining margins, particularly for diesel, gas oil, partly that's there's more Russian product out there, and we're certainly seeing a lot of Russian diesel move to places like Turkey and places in Africa. Likewise, naphtha flows to east of Suez is also having an impact on sort of the light end side of things. But fundamentally, there was also, I think we're sort of trying to get a normalized picture now where there were stock builds within Russia as well that are beginning to clear. I think that once there was also, as I mentioned earlier, a deferral on maintenance. So I think that once you actually start to, once Russia does go into slightly more heavier maintenance, then you will start to see some impact there as well on production. But also, I think that certainly the 500 KBD that was announced, that was already priced in by the market prior to once the OPEC cut was announced as well. So I think that there is an expectation that it won't be fully met. And the fundamental headline here is that Russian resilience has kept the market, softer than what, earlier expectations were. So that's obviously feeding into some of those S&D balances for the remainder of the year. I mean, it's been revised down and down almost on a monthly basis now by the IEA. So certainly this is an important factor to the market weighing on crude and product balances.
Yeah, I mean, at the beginning of the year, people had accepted that the crude embargoes or sanctions, weren't having were having actually the intended effect of keeping crude flowing, but that many were saying, but the product story is going to be different. Russia is going to be hit. Yeah. And of course, we haven't really seen that with the mixing and matching that it's been doing. And obviously that's part of the reason why we're seeing some pressure on those distillates and everything else. Rustin, back to you. Just let's talk a bit about the gas picture in Europe in the next, in the few months ahead. Do you see complacency from the political side, political leadership of, we got through the gas issue last winter, we're fine for this summer, we're not going to see this sort of gas to oil switching and that support therefore for the oil markets as we may have seen a bit of last year. What's the sentiment right now on gas going forward?
Well, I think there's I'm going to call it cautious optimism. Yes, everybody breathed a sigh of relief that we got through the winter. Granted, Mother Nature did not throw a winter at us that North America had or even Asia had. We had a fairly mild winter, so that allowed stocks to remain at a very high level. However, the EU has kept a lot of the sustainable controls in place in order to limit overconsumption of nat gas for the year. So they are keeping those controls in place they put in place for last winter, and they're going to hold them in until 2024 to see how things match up. Now, one of the things, at least going into the summer, we've had more import capacity has come online. So that's a good thing. And you have more export capacity out of the United States that have come back online. The Freeport facility, which suffered a major setback back in Q3, is now back up and running in full force. So a lot more flow can come in. And so I think, knock on wood, we'll be at a very good stock level going into the winter. And then it just depends on what the weather does at that point. So I think.
Yeah, and of course it depends on what Asia is doing too, in a sense that if we get a sudden sort of demand pull from there for gas, which of course we didn't have last year either. So I mean, could that throw a spanner in the works for Europe?
Well, if there's a cold winter, yes, it's going to throw a spanner in the works, because once you get that insipid demand, nobody wants to be cold. But that just means you have to keep your other energy that you don't want to really run online and operational. You can't just keep shutting down coal plants and other power sources just because we want to be green. People want to be warm too. But I think we'll see how it all shakes out in the wash. I mean, the current contango in the market should incentivize stock builds, and so we should see the caverns and the storage facilities get filled up as we move through summer going into Q3.
Okay, great. Yasser, just back to the OPEC story and a bit about your analysis of what's behind their thinking. I mean, they've cut twice in the last 2 months to 6 months, and they've called it right. Some people are saying because the economic indicators are sort of matching that. But is it really more about Saudi and the UAE, for example, the top two players in the recent moves, sort of creating that spare capacity? Is there any concern within OPEC about its own spare capacity to have when the market might need it?
I mean, when you look at the cuts themselves, they do create a larger spare capacity for the market and allows, OPEC, and by extension, of course, the two countries that you mentioned, Saudi Arabia and the UAE, which hold most of the spare capacity, to be flexible with dealing with the volatility that the market has in terms of higher demand, or spikes and so on. But when you look at it, this is one of the concerns. But when you go back to the 2 April decision that was made, I think this, at the core of it, is looking at the fundamentals of the market, which is supply and demand. But I think it was more about OPEC not acting just merely as a supply manager, but also attempting to manage sentiment in the market. You look at paper barrels, and you look at net long positions, they have increased, on Brent and WTI after 2 April. And I think this is part of the thinking process. The thinking process is to be proactive, is to be preemptive, as OPEC always says, trying to make sure that they are one step ahead. And when you look at the decision itself, the situation is quite redolent of October 2022, when the cuts were reintroduced. That caused a lot of outcry, but the cuts didn't tighten the market. And today, as of this point, the market is not really tightened. All our expectations are for it to be tightened in the future, in the second half. So OPEC Plus approach to counter bearishness, it may not have fully returned the required effect as of yet, because this week we have lost almost all of the price gain that came from the 2 April decision. But this will depend on how the market goes forward in terms of both fundamentals and sentiment.
Okay, Ahmed, I'll give you the final word and ask you how strongly do you think OPEC will defend that $80? I mean, we're kind of hovering below it. As Yasser just said, we've kind of erased the gains we had so far, but all this uncertainty, who knows? But let's say the second half of the year does turn out to be, demand-wise, even more bearish than expected today. Will they just keep cutting to defend that $80, or accept that the new normal has to be 60 to 70? How strongly do you think they're going to be defending that?
Sorry, I know we have like 1 minute left. Yeah. I think there's a few factors baked in that question. So I think that it's still too early, and I think the market is perhaps, still needs to see where the floor price will be. Also, don't forget that there's still the issue of, US policy around SPR, restocking, if, based around where WTI would land. So it'll be interesting to see what happens there.
They've lost credibility a bit on that front, really, the US. I mean,
And then I think also just with the point earlier made, I think it's very interesting around refining margins to see what happens as well. As Rustin said, part of that, was related to gas to liquid switching, which is gone, which may go, but, depending upon where gas prices, go as well. Inventory builds as well in distillates as part of that restocking effort ahead of the ban. There's more Russian product out there. I think all of these factors come back to the point that a lot will, as I said, it's still early to make our minds up on China. I don't think that people can confidently say that it's a foregone conclusion. Despite that, I do think that the alarm that was raised by the IEA in their last report may be overdone, because they have a very high view on Chinese demand growth this year, which is actually much higher than a lot of the the views that certainly are out there. So I think that the market is finally balanced, basically, is what I'm trying to say, and the downside risk from the fundamental side, a lot of this is going to weigh on what happens in Q3 and Q4, particularly around jet, as we mentioned, around what that reopening really looks like in terms of the borders, and also partly as well, I would say it's less of an issue, less of a factor, but I think just as important will be what the construction and real estate sector looks like as well, because that will drive some of that incremental diesel demand growth. But I agree that it's certainly, when you look at the market, there are quite a few downside risks, both on the technical side and also in terms of, the great expectations around China, and also just in terms of those what happens with refining margins. As was mentioned in the beginning, China has a huge menu of options right now. US crude, which was landing into China last month in a very big way, Russian discounted barrels, you have the Iranian flows as well. So I think that OPEC also has to be conscious of that. So whether or not they will execute another cut, I personally think that they've secured that defensive floor price of, say, $70-$75. I don't think that they will need to cut again, but we'll see.
Never say never. Exactly. Ahmed Mahdi, thank you so much, and thank you to Yasser Malki and Rustin Edwards for joining us today. Thanks so much, everyone. Have a great day.
Thank you. Bye.
Bye-bye.